Hello, and welcome back. Thank you so much for tuning in today. China's services PMI expands to 51. The data was released earlier today and shows that China's services sector continued to expand last month, signaling further economic recovery. This is bullish news. So let's see what else we can find out from this report. The official non-manufacturing PMI, which covers the service sector, was at 51.1 in September, up from 50.4 in August. This is yet another evidence that China's economy continues to recover thanks to its strict adherence to the zero-COVID policy. In this case, the higher the index, the better. Any reading above 50 is considered good. And like I said, this is yet another sign that the economy is indeed recovering. However, if we look at the details, there are some nuances here. Within the services sector, the sub-index for business activity increased to 52.4 from 51.3 in the previous month. New business also rose to 51.9 in September, from 50.8 in August. But this increase was driven mostly by new export orders, which rose to 53.1 from 52.7. New domestic orders actually fell to 50.5 in September from 51.3 in August. In addition, the employment component of the index decreased to 49.3 from 49.7 in August, which means that companies are still cutting jobs even though the economy is recovering. Of course, when the economy is just barely limping along, cutting jobs makes sense because companies need to cut costs. But this is not good news because people are not working and they have very limited incomes. So they aren't able to spend, and then businesses have even fewer revenues, which is why it is so important for the employment component to rise before other components of the index. Still, the overall index of the services sector remains above 50, which signals expansion. We should keep an eye on this employment component going forward. Another report that was released this morning beat expectations, but it was not as bullish as you may think. China's manufacturing sector grew at a slower pace than expected in September. The manufacturing PMI came in at 50.4, down from 51.5 in August. It's still above the 50 level, meaning that the sector continues to expand. However, it is worth noting that this index has been coming down consistently since July, when it peaked at 52.2. You will certainly say, okay, well, it is still above 50. So, it is still good. Well, yes, but the lower the number, the slower the growth. Moreover, this report signaled a further weakening of demand in both the domestic and external markets. The sub-index for new orders fell to 49.8 in September from 51.3 in the previous month. This was the first time in 6 months that this component came in below the 50 level. This suggests that both consumers and businesses are less willing to make new purchases at this time. This could be due to several reasons, including the ongoing geopolitical uncertainty and, of course, the fact that the Chinese real estate market, which accounts for a significant portion of the country's economic activity, is still struggling. The bottom line is that while China's economy continues to recover from the pandemic-induced slowdown, the recovery is uneven across sectors, and there are signs that the recovery may be losing momentum. The services sector is doing better than the manufacturing sector, but both sectors are still struggling with weak demand. Of course, China's economy is tightly controlled and manipulated by the government, so it isn't really free market cap. These PMIs are lagging indicators, which means that they reflect what already happened, not necessarily what is going to happen. For example, according to these reports, the services sector continued to expand in September. But as we know, the Chinese government recently introduced a variety of new COVID restrictions, especially in the wake of the Party Congress that was held earlier this month. So while the September data may be signaling expansion, the October data will likely reflect the impact of these new restrictions. It is difficult to predict how the economy will react to these new policies, especially in the short term. That is why the Chinese government is very secretive about the data it releases. Personally, I am more focused on the US economic data, because I think that the US dollar will continue to be the main driver of financial markets in the near future. And the US data clearly shows that the US economy is slowing down. And once the US economy slows down, it will affect the entire global economy, including China. Thank you for watching. Thank you for taking the time to watch this video. If you enjoyed it, hit the like button and share it with your friends. Subscribe to my channels, and I will see you in my next one soon. Bye for now.